All right, so we're just touching on some of the potential disruptions from Elon Musk. We're also looking at a new administration here in the U.S. and potential tariffs. How do you see that impacting the markets?
So European markets have, in a way, priced in most of these uncertainties through the underperformance in the second half of last year. This is our base case. And what we've done with our global allocation in the fourth quarter of last year was to move Europe as a tentative overweight, as a diversifier from this very one-way positioning just into the US and nothing else. And recently it started to work somehow, right? But Europe has been going through lots of geopolitical pressures, starting with the French election announcements. That, in our view, is broadly in the price now. If anything, actually, very recently, we've upgraded in our country allocation France to an overweight in the European country allocation. So we think broadly in the price. Now, speaking about continuing on these political risks, you've started with Germany. German snap election is a step in the right direction. In our view, it will come with corporate tax cuts, with the regulation, easier labor market. So what's not to like when you're corporate?
Right. Yeah, it's very interesting because I remember back last year during the French snap elections, that was actually a reason for you to see possible declines in European equities. But now you think that this German snap election is potentially going to be a positive for European equities. I want to go to your broader view, specifically your view on the stock 600. You gave us your price target for this year for the stock 600 is 570, a pretty much 10% upside. And then I looked, our CNBC strategist survey, the average outlook for the S&P 500 this year is 66.43, basically a 10% upside. I want to ask you, do you think the opportunity in the U.S. and European markets, are they even right now? One of the reasons for that divergence you were just talking about is U.S. tech, the fact that the U.S. has those very big tech companies with the AI trade. What equals things out this year? Because we haven't seen some big surge when it comes to European tech companies.
There is one thing which will equal it out, and that's the broadening of EPS. So on the top of these political pressures that we've spoken about already, Europe has underperformed since the French election has been announced because of downgrades to the EPS. So from being the most upgraded EPS market in the world in the first half of the year, it ended up being the most downgraded market, right? And within the region, within European equities, there have been many sectors, cyclical sectors, that actually have undergone EPS recessions. Now, in the US, the US EPS hasn't been downgraded at all. MAC 7 have been upgraded, but the rest of the index, ex MAC 7, have been downgraded by the similar ranges as European index. So the driver of outperformance and the outperformance of the EPS in the US last year has been MAC 7, has been AI, right? Into this year, the expectation is for these stocks to still grow substantially, but not as much as last year, and for the rest of the index in the US to start picking up. So that's broadening of the EPS. In Europe, because of these recessionary levels that we've seen for many sectors and negative numbers last year, we see almost all of the sectors picking up a positive growth rate this year. So there is going to be a bit of the broadening up of the EPS, which should be helpful for Europe.